Hello everyone, this is Bhavik Chokshi again. Hope you guys are doing great. We will continue with our amendment series, and today we would be discussing the changes in the new study material for Ind AS 20, that is on government grants. To be specific, there are two changes as we have outlined. First is the changes in illustration number 6, where the institute has made a small alternative treatment on the government grants, which are non-monetary grants. And second, they've added a new illustration in the test your knowledge section, which is a slightly good question, which is on EPCG. So we'll quickly discuss these 2 points. First of all, so let's go to that part. So first of all, we go to the treatment of non-monetary grants. Now these are grants on assets which are received, which are either taken at a concessional price or free of cost. The older standard, the older Ind AS, at least the older version, required you to record the assets at fair value only. Now, under the new version, the institute has mentioned that we can record it at fair value. So the old treatment continues. You can, in these circumstances, the fair value of non-monetary asset is assessed, and both the grant and the asset are recorded at fair value. But it also gives you an additional option that if you want, you can show it at the nominal value. Alternatively, an entity might measure these grants at nominal value. So basically, for non-monetary grants which are received at either concessional rate or free, you can either record the asset at its fair value and take the difference to deferred grant account, or you can record the asset at the nominal value, in which case there is no deferred grant account. So accordingly, your illustration 6 gets slightly modified, where we get 5 acres of land which are having a fair value of 1 lakh per acre, and hence a total value of 5 lakhs at a nominal value of 50,000 of 10,000 an acre, which gives you a total value of 50,000. So as we have solved earlier, the grant can be recorded at 4 lakh 50. You can take the asset at 5 lakhs. So land account debit 5 lakhs to bank 50,000 to the deferred grant 4 lakh 50. Or alternatively, the land may be recognized at nominal value. Remember, this is merely an alternative treatment. In the exam, if a non-monetary grant comes, I would still advise you solve using the fair value method only. Do not stick to the nominal value unless the question specifically tells you to do so. I'm sorry. Okay. This is on the first change. So not really an amendment, but just an alternative treatment being added. Having said that, I would still keep our solution at question number 6 to remain the same, only no change, just an alternative point added. The next part where we are trying to make trying to study the difference is in this third question. This is a new question. This is on EPCG. Once you go through the question, you will realize that the institute is asking you that if there is an import concession that is availed in an EPCG scheme, the export promotion and capital goods scheme, should that be accounted for as a government grant or not? The EPCG scheme, so if we just read the question quickly, MNC has received a grant in the nature of exemption of custom duty on capital goods with certain conditions relating to export under the EPCG scheme. Whether the same is a government grant under Ind AS 20, if yes, how is the same accounted for? Is it to be treated as a grant on asset or a grant on income? Okay, first of all, we'll quickly try to understand what is an EPCG scheme. Under the EPCG scheme, you will generally import capital goods from a foreign country, and the purpose of importing these capital goods is to use them for manufacturing products which can be exported. So for example, you are buying a machine from Germany which is having a value of 10 crores and is ideally subjected to a custom duty of 50%. Let us say at 50%, that is at 5 crores. So the government says that if you are buying this under the EPCG scheme, we will not charge you the customs duty of 5 crores, in which case you end up paying only the 10 crore amount. You do not pay the customs duty of 5 crores. Once you pay the 10 crores and you do not pay 5 crores, should this be treated as a grant or not is the question. if it is an EPCG scheme, normally it is tied up to export obligations. So the government says that if you want the benefit of a waiver of export duty, of import duty, in let us say a period of 5 years, you will have to import components, if you will have to export components worth let us say 20 crores. So the government is trying to meet or help or trying to increase the export, in which case the concession in customs duty that you are getting is tied up to an export obligation that you have. So you have to meet an export obligation of let us say 20 crores of sales in exports in order for you to be entitled to the EPCG benefit. What if you don't meet the obligation? Well, you have to refund the duty. So is it a government grant? As per the standard, yes, this is a government grant. How do you record this grant? Should it be recorded in the nature of asset or should it be recorded in the nature of income? Remember, this grant helps you in meeting your export obligations and hence should be treated in the nature of income ideally, which should be amortized in the ratio when the export obligations are actually met. So for example, if in our original example, if we just try to do it in a quick numerical, so let us say okay, let us say you have a machinery which had an import cost of 10 crores on which you had an import duty which was waived off, which was exempted under the EPCG scheme. This is an import duty of 5 crores and hence 5 crores will be treated as a deferred income. You will treat 5 crores into the deferred income account. Now, how will you amortize this into the P&L account? Let us say the government requires you to meet an export commitment of let us say 10 crores. Or let us say for simplicity 5 crores over a period of 5 years, in which case you are expecting in year 1 you will have 1, in year 2 you will have 1, in year 3 you will have 2, in year 4.5 and year 5.5. In which case this deferred grant of 5 will be amortized in the years when the actual export happens. So this is a grant which is helping you to export and hence you treat it as a grant in the nature of income. And you should record it, defer it to the PL in the ratio when the export goes to the PNL. The institute has also given an extra alternative that if the grant can be attributable to the capital asset, it can be treated as an asset. Having said that, if you read the EPCG scheme properly, the first treatment is more suitable. So if you read this question, two things: is EPCG import duty concession a government grant? The answer is yes. How should you treat it? You should treat it as a grant in the nature of income, which should be deferred in the ratio when the export obligations go to the when the exports go to the PNL. Great. So that should be it on Ind AS 20. If the video was helpful, please do like, share, subscribe, and I'll see you tomorrow then. Thank you.